While many investors are worried that the AI trade is turning into a massive bubble, Tom Lee sees things very differently. He points out that the semiconductor index is still trading at only around 22 times forward PE, suggesting AI stocks may not actually be as expensive as many people think. Let's hear why.
You know, what's interesting to me is you say that the risk reward in the market is still positive. I'm wondering, though, whether that spread is starting to narrow.
Hi, good afternoon, Scott. To us, stocks are rising for the right reasons. I know I've said that before because we've had good earnings, but also just evidence of really the scarcity of compute and the supply chain, whether it's semis and energy, and AMD's the latest example. But the market hasn't made these stocks expensive yet. The forward PE of the semi index is still only 22 times, and while that might sound high because they were expensive, more expensive than a month ago, they'd gotten as high as 35 times over the last 20 years. So to me, there's still pretty good risk reward, even in the stocks that are leading this rally.
Even with AI hype and market enthusiasm running hot, Tom Lee still believes the market could see a 15% to 20% pullback later this year before continuing even higher into year end.
But see, I look at what you still suggest is a three-phase market. That's how you characterize it. A rise of the S&P to 7,300, check, right? We're there, beyond it. But then you talk about headwinds emerging. See, as we started this year, to refresh everybody's memory, you thought we were going to have a really good start to the year. We would drift into a bear market before another upswing would take us even higher into the end of the year. Now, when the war broke out and we had about 10% or so pullback in the S&P, I thought, well, maybe that's Tom's moment. He couldn't get the timing right, because who can? But that was the pullback, and now we're so bulled up on AI that maybe we're going to do just fine for the rest of the year. But you're still looking for a drawdown of 15 to 20%. Is that right?
I am, Scott. I think that 7,300 originally was like an aspirational level, and now that we're here, I think that there still is fuel for a move higher from here. But we do have to confront later this year two things, and maybe it won't affect the markets, but I think it's the trigger for a drawdown. One is, of course, the market will test a new Fed, and this incoming Fed chair has some different theories on the sources of inflation and how to read inflation, and so the market, I believe, will put those views to the test. And of course, the second is that every day that the strait is closed, we know that there's an acute shortage developing of petroleum products. So if price reacts later this year, that's going to test the market. So I do think there's the ingredients for turbulence later, but AI and the scarcity, and the U.S. is the provider of that scarcity, is why I think we can exit 77 or higher, and maybe 2027 is one of the biggest rallies we see in our lifetime. So I think it's still a bullish outlook, but turbulence in the middle.